Mark, I look at what Bloomberg Intelligence is writing in the last few hours, and they're pointing out that for reserve managers in China, the geopolitics and the suggested returns aren't really a priority for them. But, you know, in terms of what bigger story this tells us, the amount of anxiety and trepidation in these markets around where bond yields should or should not be going, what impression did you get? I mean, is this really part of a turnaround story here?
I really don't think so. We've seen this movie play out many times before over the last year or so, and we'll probably see it play out again. We see yields go up towards the highs, and then we wheel out all the regular names. Quite often it is Bill Gross and Jeffrey Gundlach who call for this bear market, and then we see yields come back lower. The fact is we have structural disinflationary pressures that are very strong, and in this world with kind of stretched valuations across many assets, Treasuries do offer relatively attractive yields, given that inflation in the US is still very low. It has been low for many, many years. It's hard to call it transitory when it's lasted for so many years, and so whenever there's a spike up in yields, there will be appetite to kind of pile in again, and we saw that in the auction yesterday. So there'll continue to be demand for treasuries when yields spike up. This doesn't mean that yields can't reach higher levels again, and it's interesting to note that Bill Gross later clarified, as you showed in that show, that despite he said a bear market, he's talking about 2.7%, 2.8% at the end of this year. That's only 15 basis points above where we are now in the 10-year. So even someone who's calling for the bond bear market doesn't think we're going to get much of a move higher in yields. This is not a big turning point. It's the usual story, and in fact, in the wake of China's clarification, and it did seem strange yesterday that they were going to say they're going to buy less yields, more mature investors kind of had said, look, this is either a negotiating ploy in terms of trade policy, or perhaps it's a misunderstood story. They have clarified it was a misunderstood story. In the wake of that news, I think we'll actually see yields come lower in the next few weeks. Overall this year, we might see yields trending higher, but in a very volatile fashion, and they won't go very far.
The record run in U.S. equities took a bit of a pause in the last trading session. We put up on a chart where we are with some of those gains and also what's happening with U.S. 10-year. G-Space, hashtag BTV Space 7085. Your 10-year and your S&P current earnings yield in terms of the Fed model looking less justifiable. Also, the spread clearly laid out 1.8 at the last data point. In terms of the road ahead, what's going to yield the best returns if valuations are set to be stretched? And if most asset classes look overvalued, does that leave room for a lot of gains in commodities? Because we've had a lot more voices on this program and many other shows as well who are saying commodities, despite the recent rally, have a lot more room to go here, Mark.
Well, then there's two things to say. First of all, I don't think equities are necessarily as stretched as it might imply. A lot of those earning forecasts have not been upgraded in the wake of the tax kind of reform that's come through. And tax reform has made US stocks no longer look so stretched, no longer look so expensive. A lot of people use the Cape-Shiller method, but it underestimates the fact that the discount rate is sustainably lower in kind of government yields around the world. So valuation should be higher based on those kind of old, outdated metrics. Now we've had the tax reform, and that's going to raise earnings for corporates. It may not boost growth that much, but it will raise earnings, which suddenly will make the PE, forward-looking PE ratios look slightly less stretched. I'm not saying that US equities are cheap. I am expecting more volatility this year, but it doesn't look like particularly negative. Global growth is good, earnings are good, and earnings are being boosted yet again, and therefore overall the bull market in equities should continue higher. As for commodities, as long as growth is strong, commodities should continue to do well as well. It may depend slightly on how the dollar is doing. Last year was a very negative year for the dollar. I think the outlook for the dollar still remains bearish, but maybe not as bearish as last year. Last year there was a complete coincidence of events. The market was very bulled up on a very strange framework, very strange narrative, even though the fundamentals were very negative. This year, the fundamentals are still negative, but not as negative. In fact, US growth is doing better relative to peers than it was last year, where it was middle of the pack. This year, only Australia and New Zealand are outperforming the US in terms of developed market growth, and yet the narrative has changed. People have become more negative about the US. So I think the dollar might trade poorly, but not as poorly as last year.